Hey, welcome back to Research and Design Finance. Today we're going to be going over the top ETF mistakes in 2024. I've made some. I want to make sure you don't. Make sure you stick around, hit subscribe, make sure you smash the like button, and as always, make sure you understand what you're doing. Heed a little bit of warning from me. Don't make all the mistakes I did. Let's jump right in. First things first is, what are the top five? And we're going to go through those 1 through 5, but it's not necessarily going to be in best to worst or worst to best, just a random assortment that I found to be the most interesting and has the most impact if not heeded correctly. Okay, so number 1 is the ETF structure and the mechanics. So what's inside that ETF that you're looking at? Case in point, let's jump right over into M1. This is a website I use to go over, invest in and look at stocks, whether it's an ETF, whether it's a mutual fund, whether it's just a normal stock. So let's just jump right in. These are some of the ETFs that it gives you right in the beginning. So these are Vanguard funds, these are Invesco, these could be BlackRock, it could be Sector Spider, it could be Vanguard, whatever those may be. But not understanding the mechanics inside that ETF could have profound mistakes on your overall wealth. What do I mean by that? Let's take VOO for example. I'm going to pull up VOO here, and it's a Vanguard fund. It mirrors the entire stock market. If you go down here, it'll tell you this fund is passively managed. I'm not going to do a deep dive into VOO, but basically understanding that what the yield is, what the expense ratio is, what the beta is, what's it invested in. So are these companies that are more tech focused, consumer discretionary, consumer durables, healthcare? What are the mechanics in there? Is it made up of just stock? Is it cash? Here we see almost 100% is made up of cash, or of equity, sorry, and a little bit of cash. But if you go down here, the top holdings, what do these look like? Well, almost all of them are tech companies. So not understanding what's actually in there and saying, well, I'm just going to broadly invest in a Vanguard fund can be detrimental. Why do I say that? Well, number one, what if you work at Microsoft? What if you work at Nvidia? What if you work at Meta? You may not want to invest in a fund if you work at Microsoft that's already 7.25% heavy. If I look at actually the Vanguard fund here, it'll tell you it invests in stocks in the S&P 500 index representing 500 of the largest companies. But if you work at one of these big tech companies, you may have RSUs, you may have stock options, you may have a large percentage of your 401k tied into that, and that may or may not be a good thing. You certainly don't want to be overweight one stock, as that stock could drag down your portfolio as well as the fees. So understanding what's in there, understanding potentially what the minimum investments are, do they pay a dividend, what's been the price change over the last few years, what's the annual fee that you pay, what does that look like? Again, I talked about average expense ratio of similar funds. So if you're looking at VOO here and it's a 0.03, so 3 basis points, but the average expense ratio of a similar fund is 79 basis points or 0.79, you know you're in a good spot, right? As long as the yield's there, the performance is there, it's investing in companies that you like, you're good. But if you saw, for instance, that the expense ratio of this fund maybe is 1% and the fund average of similar funds is 0.79, you may want to stop, pull back, and have a further discussion. All right, that's number 1, and that's a big one. Number 2 is ignoring expense ratios. So if I go back here to VOO, we just talked about the expense ratio, but let's dive a little deeper. 0.03, that's a very, very low expense ratio. So you always want to try and go the lowest amount of fees you can for the highest possible performance. You know, you also want to look at net asset value, you want to look at dividend yield, you want to look at things like that. But expense ratios can have, again, a profound effect on the fund's performance, not just now, but over the lifespan. That's why things like active advisors that charge 1% of assets under management, or they do a 2 and 20, say 2% of assets under management, then 20% of alpha, can be great. You just have to be very careful in what you're doing. I'm going to move back over here into M1 and say maybe my expense ratio, actually let's just look at expense ratio and stack them here. So if I go, there's almost 2,000 funds here on M1, and this is across, again, all different providers of ETFs. So not just Vanguard, not just State Street, not just BlackRock. If I look at this Van Eck Vectors BDC Income ETF, it's almost a little over 11%. So to put that into context, for every $100 you put in, they're going to take $11.17 to manage it. That's just to manage it. That's not a return. It's not a guaranteed return. So if I looked at this fund, I would want to see what the returns have been like. I would also want to see what the dividend yield is. So in this case, the expense ratio here is the highest I've ever seen. I didn't even know there was an expense ratio at 11%. The dividend yield is not even enough to make up for the expense ratio, but let's look at the fund over the last, let's say 5 years. Well, actually, the fund is down 33 cents or almost 2% in the last 5 years, on top of paying 11.17% and an expense ratio. So really, you got whacked across the head twice. You got whacked for the expense ratio, and you got whacked because you're actually losing money here, down 33 cents a share over the last cumulative 5 years. Now, of course, you've taken in dividends in that time, but the appreciation on capital, the alpha there, has not kept up with even the expense ratio that you're paying. If I go down here, let's see what they're actually invested in. These are just other funds as well. So you've got Goldman Sachs, you've got a Hercules Capital. This is something that if someone said they wanted to invest in this, I would tell them to take a long, hard look at all the expenses you're paying out. I don't know if they have a consistent history of increasing dividends over this time. Let's see, 41 cents, 39, 37, 36, 38, 32, 38. I mean, they started at, let's say, 41 cents. And they're basically at 47 5 years, almost 5 years later. That's not something I would invest in. I think there's other places to put your money into, and I think you'll have a much better chance at a higher percentage return, not only on the dividend side, but on a gross appreciation of capital if you understand that. All right, number 3 is overlooking portfolio diversification. Again, kind of back to point number 1 around mechanics. But if I go into, we'll go back here again and look at portfolio diversification. Here we're just looking at expense ratios. Let's look at some of the lowest expense ratioed. Actually, let's look at, here's what we need to do. So let's say we want miscellaneous, and I could go into, I'm trying to find a good one here. Let's just say equities, and we'll say the lowest expense ratio. All right, so let's look at something. Here's a large cap ETF from Schwab at a 0.03 expense ratio. Okay, sounds great, right? Low expense ratio, Schwab's a good name, decent dividend, but let's see what kind of diversification we get in here. Okay, so the top holdings, tech, non-tech, pharmaceutical, tech. That's not good unless if you understand it. But if you don't understand that and you just blindly invest and say, well, it's a low expense ratio, the dividend's not bad, the beta is a little over 1, which is good. Your 52-week range, 44.95 to 60, that's almost 25% increase. And over the last 5 years, let's see what it's done. It's up 80%. There was the dip from COVID, and we've came right back out of it. And since the beginning of this year, it should be up almost 7%. Seems great, right? Unless tech starts to have a really bad day, and then guess what? Your top 10 holdings, 8 of the 10 are tech. You're going to drown in there. So actually, let's open up and see what they have on their actual page, the prospectus. Let's look at the fund details. It's to track as closely as possible before tease the total return of the Dow Jones US large cap total stock market. Sounds great, right? And again, it could be. The problem is that tech now makes up such a huge part of that if I look in the portfolio here, we'll see tech. Like I said, tech. So again, 6 points. Let's actually, what does this look like? Let's see. 2, 3. That's about 23% just in the top 6 holdings. So that's something you need to be aware of is, if you're okay with that and you're okay with having an outsized amount of sector analysis or sector variance here from an IT perspective in almost 30%, go ahead and invest. It's almost all stocks. There's not much cash. They do dividend distributions. My guess is, every quarter, every 3 months. And I believe the distribution, it keeps going up. So again, not a problem. You just need to understand that. All right, portfolio diversification. Let's look at number 4, which is chasing performance. If you're only chasing performance, you're only looking at hey, how much can I make as fast as I can? That's also a red flag. Going back to M1 and going back to our sector or our ETF analysis, if I go look at the 5-year return and just blindly stack rank on a 5-year return, what does that look like? Let's actually see. So let's look at price history. Oh my God. I didn't even look at this until I was making this video, but this actually just proves my point even more. What could possibly be up 66 million%? Let's look at this and see what this is. I actually am curious to see what this is. Okay, so I don't think that's right. At least over the last 5 years, this is a bad example. Let's look at this next one. 477% in the last 5 years. Again, I don't think that's right. But let's look at something over the last 5 years that I've actually seen. TQQQ. This is a triple levered ETF. For those that don't know, a triple levered ETF is something that will triple when it's up and triple when it's down at a very high level. So you get a lot more volatility. It's a 3x levered exposure to modified market cap weighted index, tracking 100 of the largest non-financial firms on NASDAQ. So triple levered could be really good or it could be really bad. Again, you need to understand your volatility and your risk ratio. But in this case, if I'm just chasing pure performance, this is up 369% over the last 5 years. It sounds great, but it's really not, in a sense that it could easily go the other way. And when it goes bad, it goes really bad. So in terms of they're using options in this, I don't think they are. But instead of having a day where you're up 30%, you could easily have a day where you're down 90%. Instead of having a day where you're up 10%, you could have a day where you're down 30%. Triple levered ETFs are fine, again, if you understand and know what you're doing. Microsoft, Nvidia, Apple, again, huge holdings in here that are all tech weighted, because of what's happened in tech over the last few years and their ability to just drive in huge amounts of profit at an insane margin. This fund in here does pay a dividend, but actually they just started paying, looks like they were paying 0 cents for a dividend. It looks like they stopped their dividend for a while. Again, if you're just chasing performance and you don't understand the underlying variables, this expense ratio is almost 1%. It's just not something, it's something you need to understand. Again, it has to be, there's always a balance to these things. It's not just expense ratio or dividend or performance or sector analysis or risk variance or volatility. It's all of it together. It's not an and conversation. All right, number 5, and this is probably one of the most important, is failing to review and adjust holdings regularly. If I go back here and I look at, let's go back to VOO. Actually, let's go back to a very low expense ratio, and we'll look over 5 years and we'll say a low expense ratio. Actually, let's do a complete reset and let's look at let's go to VIG and say we're just looking at dividend. This is a Vanguard fund that just does, and I'm just picking on this one. I'm not saying it's good or bad. It's just one that stood out and one that I've invested in. If this is a fund that tracks for dividend appreciation, this is one that it tracks a market cap weighted index of companies that have increased their annual dividends for 10 or more consecutive years. And that's great, right? But there's more to investing than just dividends. But if I'm not careful and I'm thinking I just want dividends, I'm again going to end up potentially very tech heavy. So I've got tech, non-tech, I've got financial, I've got healthcare, I've got oil and gas, energy, I've got more financial, tech, financial, healthcare. I've got actually a pretty good mix here. But if you're not careful over time, what if those dividends from the non-tech companies or the tech companies start to outrank MasterCard or Exxon or Visa or Johnson & Johnson? Then your portfolio becomes tech heavy as well while you're still getting those investments. That may not track to what you want, and it may not work for every investor, where just blindly putting money into a fund like this generally is okay. Over the last 5 years, it's up 63% and it has a yield of 1.79. You know you're getting your dividends and you know they're going to increase. But again, you may rotate too heavy into one sector, in this case being tech. Okay, so that's my top 5 for 2024. What made the cut for you? What did you like? Anything I missed? Please leave a comment down below. And as always, don't forget to design your financial freedom. Take care. Bye-bye.